everyone. I'm Denise Garth, Chief Strategy Officer at Majesco, and you're listening to the Future of Insurance Industry Leaders podcast series. Follow along as I interview the best and brightest leaders in the insurance industry and insurtech landscape to bring you the latest in digital transformation, innovation, industry trends, challenges, and opportunities, as well as next-gen technologies. We use our experience to anticipate what's next without losing sight of what's now. Stay tuned to find out your next now. I'm thrilled today. This is our typical January Trends for the Next Year webinar. And this year I am extremely excited to have three really strong leaders in our industry that have some really great perspectives. And what we're going to focus on are what are we've got kind of four key trends that we think are really vital for the industry and companies to compete and accelerate in this new era of intelligent insurance. So joining me today is Rob McIsaac, President and CEO of RPM Ventures. Some of you may have previously known him in his different roles as industry analyst with Datos and Novarica. Lisa Wardlaw, President and founder of 360 Digital Immersion, a key insurtech influencer out in the market, speaking in many places. And then Jim DeMarco, the insurance advisory lead for Microsoft with regard to insurance strategy. So really three really powerful speakers, really great insights. And so I'm looking forward to the conversation. Welcome, Rob, Lisa, and Jim.
Great to be with you, Denise. Thank you.
Thanks for having us.
All right. So when we got together, we kind of have some areas of focus in the four, and then we're going to do a bold prediction at the end. So the first topic is high performance insurance operating models. And, you know, when we think about insurance operating models, many of them were crafted over decades ago around a myriad of constraints and different business assumptions, a different time, challenges, and different technology. And today, the operating model really needs to evolve to support modern insurance and a modern area of insurance in the market. And how we get that from the old legacy construct to this modern perspective. But when we talked about it in terms of there's a lot of micro, macro economic environment impacts to this operating model today. Rob, give your view of that to get us started.
Sure. Well, I mean, I think it's a really interesting question for all of us to consider. You know, in my career, I've been a CIO for a property and casualty company, for a life and annuity carrier in the group insurance and voluntary benefit space. And yet, I don't think we've ever seen in my career this much change happening this quickly, impacting so many people and the technology and operational decisions they have made or will make. You know, when you look at where we are right now, it's the back half of the decade for sure. It is also the beginning of the second quarter of the century. We are going to look at really significant demographic shifts that will take place, which impact the people inside insurance companies. But it also impacts the distribution networks, and it impacts the consumers, and it's going to impact the products that companies bring to market. And yet, some of the things that exist right now, because of the net long liability nature of the products on the books, companies need to be almost thinking in a barbell fashion. What do you need to do in order to effectively manage the things that you already have, which are paying the freight and keeping the organization alive, but also allowing you to make investments for the future? And how people consider things like home ownership or family formation or even vehicles that they drive or don't drive. All of that's going to have a material impact on the products that need to be taken to market. And then the question of how people will be able to access those products in new and different ways is something that I think is very much on the table. So I think one of the things that, in my experience at working at places like Prudential and Guardian and Nationwide, was that in insurance, historically, we like to find the best answer to a particular problem statement and then pursue that with all due respect from our resources. And I think that at times in the past, broadly speaking, that led to one-size-fits-all solutions. And now I think we live in a world where that actually could lead to a world of one-size-fits-none. So companies need to think very differently as they go to market. That has implications for the products and real implications for the technology and the technology relationships they want to build out. So I think it's a very exciting time. There's an awful lot about this that I think is fascinating, but this is not Back to the Future. This is a very different world that we're headed into.
So one of the things that we talked about when we were prepping for this, Lisa, that I want to kind of bring in and add another kind of layer to this conversation is that insurers need to kind of change the economics around a lot of their key metrics, the loss ratios, the expense ratios, obviously risk selection, from an underwriting perspective. And they have to kind of emerge away from the dependence on investment returns that kind of layer in or sometimes hide what's really happening and the inefficiencies within the operating model. What do insurers need to change, and how can they kind of move to a new operating model that creates greater value that can really achieve the full potential of their strategy? Lisa?
Yeah, and that's clearly my CFO brain loves that. Can you hear me?
Yep.
Can you hear me, Denise?
Yes.
Okay, sorry. So I'm sorry, I was trying to make sure I was talking into the mic. I would say that, this question hits so many levels for me, given my CFO background, as well as my tech innovation lens. I guess, I'll be a little provocative. I'm sure you don't mind that, Denise.
Nope.
But I think that we fixate so much on this expense ratio and managing the expenses and operational efficiency. And if I had a dime for every startup that's like, we're going to save so much money if they just implement this bolt-on piece of technology. And I will preface this by saying, yes, you unequivocally have to be efficient and ridiculously operationally savvy with how you manage an insurance company, carrier, reinsurer, et cetera. I kind of think of that as like getting out of bed in the morning and brushing your teeth. And he's like, duh. But what I think that we forget is that economics that move the needle don't typically sit in, I'll call it like the G&A operational expense line items. They sit in much bigger things on, I'll give an example for P&C, frequency and severity, because we're all prepping for, Stormageddon here. Replacement costs, repair costs, how the price of supply and lumber is exponentially going up after a major event. And so I think very much that when we think of technology foundations, we need to think more on the interoperability of our derivative, our treasury, our ALM skills in tandem with what we're pricing, the products we're serving, and how do we drive the economic yield down. I mean, Denise, honestly, that's where we get billions on the balance sheet, not a couple 100,000. And I'm being really serious about that, because I used to tell people, my department overhead is probably only worth X, and you're asking me to spend Y on technology, and then times, 10 vendors, there's only so much of that I can do. And my people are actually already pretty efficient, and the processes, yes, they need to be improved, but they're not horrible. So what is it really that I'm after? And I think, Denise, what we have to go after is less incremental optimization and more, how do we drive to the point that we were just talking about, how do we drive different products that can be priced and optimized much more efficiently? And I think that comes into a much higher level of technology foundation.
Yeah, and to build on that concept, Jim, if we're looking at a different operating model and the financial metrics that Lisa talked about and Rob talked about, obviously that technology foundation has to be very different. We made a shift back in, 2017, 2018 to go to cloud native. We're now in a world where we've got to go to cloud native and AI native, and we are hindered so much by legacy debt that's really poisoning and pulling organizations down with the inability to bring new products to market to drive that optimization and stuff. So give your kind of point of view of this, of how do we address the impact of legacy and move into this new world of cloud and AI native technology that can really create value, Jim?
Yeah, I'd love to pick up on something, pick it up and tie it back to Lisa, what you just said. Peter Drucker, everybody knows him as the guy who said culture eats strategy for breakfast. He also said that there's nothing so useless as to make more efficient that which should not be done at all. And I think it exactly brings to exactly where we're at. We have been incrementalizing our improvements on existing processes for the last X number of years. It probably started in the 1980s when we started saying, let us look at business process outsourcing as a way to incrementally improve our overall programs and drive sort of certain costs in the business. As we're seeing what the technology has evolved to at this point, and also how we're seeing the work environment evolve, as was mentioned with respect to like simply the barbell problem, the change in how we're looking at the workforce. We see a couple things evolve. One is that we're still constrained by legacy process as much as anything else. Legacy process was originally sort of a problem because if we wanted to put in a big piece of tech, we'd put in a big piece of tech, and that tech had a well-defined process, and you just adapted your company to whatever that process was. And in the insurance patch, we got really good at saying, I have a piece of tech for this particular type of offering or product, I have a different piece of tech for a slightly different product, and now we have two different processes. And we had sort of this thousand flowers bloom in processing. With the evolution of AI, we're seeing absolutely the opportunity now for us to say, let us look at radically changing that, to say, let us not look at what our process is and then how do I make it slightly more efficient, but let me actually understand what the outcome is I'm trying to seek and work my way back into letting the tech sort of take care of itself on the process. The challenge we have is that we've spent a lot of money on that tech, and there is a very huge sunk cost argument that we're facing inside of our operations model to say, gosh, I've spent so much money on this, I don't want to actually change that. It is as much a cultural problem as it is a technology problem. And it's honestly, tech debt is usually a cultural issue. We spent the money, sunk cost. And now we're seeing a change, the ability to actually really rethink how we do the offerings, and that change and ability to deliver offerings or deliver outcomes faster, better, stronger only occurs if we can actually say, well, we need to actually rethink the process itself.
Hey, Denise, before we go on, I'd like to just tag on to what Jim said, because I think it's absolutely correct, and I think it actually points at one of the fundamental problems or issues facing the industry. There was a recent report that McKinsey published, not that I'm advertising for McKinsey, but it's a really good report that talks about agentic AI and some of the capabilities that companies across industries can achieve in the future, leveraging some of the emergent technology. But the main point of the article is that it's really about fundamentally rethinking process. It's not about applying new technology to old process, or as we would say here in North Carolina, it's not about putting really expensive lipstick on a really ugly pig. It's about rethinking how we're going to do some of these things, to Jim's point, which then begs the question, who exactly is going to do some of that rethinking? And then I think if you expand it a little bit further, it turns it out to not really be a technology problem, but actually a problem around how you go about change management. Because if we're talking about moving cheese now, we're talking about moving a whole lot of cheese in a hurry if companies are going to take advantage of these capabilities. And it's easy to talk about the magic pixie dust of AI that gets sprinkled on everything and turns into magical solutions. Not likely that's actually going to happen. It's about a fundamental rethink, and that's really hard for companies to do.
Yeah, and that's a great segue into the next topic. And Lisa, I'm gonna go to you first. Sure. Everybody, there's a lot of great reports out there from a wide variety. Even AM Best has some stuff around, the impact of AI. Morgan Stanley just recently did, and how it's creating real business value, to your point, Jim, at creating really great outcomes and really changing the metrics. Some are saying it's an overpromise and it's underappreciated, But at the end of the day, some of this is really tied back to strategy and how that comes into play to say, how are we going to operate differently, and the technology foundation, rather than looking at one-offs of, oh, let's go play with AI over here, let's go do this, and you can never really unlock the overall compounded benefit of it. Lisa, what's kind of your view on this from a strategy and an execution perspective?
Well, I think exactly as we've been talking, right? We're trying to solve like problems that we shouldn't be trying to solve for. We should, we're trying to incrementally improve things with AI, which is the kind of, I call it the POC pilot trap. I mean, there's been so many reports written about that, the 95% failure rate, all the things. What we fail to understand, and I was actually just having this conversation yesterday, Denise, with a group of executives, is that we as business leaders knew and know, like, this is a problem. This is a fundamental business problem. And we kind of have ideas about, like, wouldn't it be nice if we could do this, that, and the other? And I would say the pervasive problem over the decades I've been in insurance, I won't name how many, has been that the technology was not an enabler. The technology was, in fact, a constraint because we could only go so far. We could only afford so much. I mean, I even hate the word minimum viable product. There should have never been an minimal. There should have been a, what does the business need? Like, what does the business want? How do we do that? And so I think, Denise, that when we reimagine, if you just assume that you can have the technology achieve anything you want, just a hypothetical, I'm going to assume that anything I draw on a whiteboard can in fact be done, because honestly, we are not that far from that being a truth. Then what you do is you say, how do I do this in a way that is organic and natural? Not in a way that is like 20 reverse engineered, bolted on, badly remodeled rooms, but like, how would I do this? And then you partner with your tech team, and then you bring in, I'll call it like the AI and the foundational stuff, where it optimizes things like dynamic, rapid processing of decisions, real-time communication, kind of aggregating and doing all these things much more exponentially quickly, risk decisioning, architecture instead of risk management, Denise, as an example. And so I think where we've gone wrong and why all these reports are being published is that we took the old adage of business process improvement and we said, let's throw AI at that, which is all these little POCs. And then, of course, we had we got to prove value. So that even further amplified it, which, again, as a CFO, I understand. What we need to do is take an interoperable thing and reimagine it and execute that. And Denise, I'll go one step further. The people that are not doing that are going to lose, because people are going to start doing that, and it's going to become, back to the KPIs I talked about in the first segment, it's going to become P&L risk arbitrage, meaning you're going to start accepting really bad risk and your peers aren't. And those are numbers that become 500 million and $1 billion very quickly.
So love that. And Jim, I'd like to kind of turn to you, because yesterday I was talking to a CEO of a P&C insurer as well, Lisa, and one of the things that we were talking about from an AI perspective is how it's going to reduce friction. And it's not just friction within the process, but it's friction within how you effectively optimize the business and drive down the expenses to be able to be more competitive in the market. And Jim, I know you're working with a lot of insurers as well as technology companies, around AI, given that you guys, were really early on the scene on this whole thing. What are you seeing from a level of operational optimization that's truly going to change the economic dynamics within insurance companies to drive down those costs, to make them more competitive? And where do you think the focus needs to be for insurers over the next 12 to 18 months?
Denise, I'd like to take the second one first. I think because we have spent, as a business, an old friend of mine in insurance business said the two ways we make money, or three ways we make money, are to sell more policies and then to pay less on the policies we've got, and then we make some money on float. And we have spent an awful lot of time on that second bucket of like, let's just optimize. And while there has been an enormous amount of value that has been driven out of optimization for sure, the focus going forward, honestly, I believe will be shifting more towards the other parts of that value chain, the ability to actually grow as we look at things. We started with the use of AI in the place everybody expected us to start. It was in internal operations and in claims. Why? Because those go straight to the bottom line. And the thesis was, if I can do that, I've won. But to Rob's earlier point, that's also where we have seen organizationally, it doesn't change our structures all that much. It does not enable the growth. So as we see going forward, we're starting to see very much in the customer conversations we're having, the focus in on how do I actually adjust my appetite? What are the additional services that I can actually bring to bear that will actually be profitable? How do I basically sell more for what I've got, and not just sell more for what I've got, but actually sell more accurately on what I've got? That's going to be a fundamental shift, I think, over the course of the next 12 months. It is clear that we have been able to reduce certain amounts of friction with the use of AI in processes that were just bad. We're running out of processes that were just bad. So now it's like, let me actually eliminate or processes that don't need to be there in the first place, or let me actually rethink the outcome approach. That's the next fundamental shift. I know, Rob, you brought up the McKinsey article. I'll bring up one of their primary competitors, BCG, came out with a great article back in, I think it was August, September. They talked about how the insurance industry has actually adopted AI at a faster rate than any other industry on the planet, except for tech. And the thing is that not a lot of people in insurance have scaled it, precisely because they've spent it on existing projects and existing capabilities. And how we look at the shift towards not just reducing friction in existing programs, but actually looking at the shift towards how do I enable the company to deliver more. That's the shift I think we're going to see going forward. Optimization's worked. It's time to actually start looking at growth too. I want to make sure I answered your question directly, Denise.
No, that's great, and I kind of want to tie that back into something Rob said earlier. And Rob, it really gets to the value of this is really looking at it from a cultural standpoint and change management perspective. We've got this shift in demographics of employees, and we've got retirements continuing, and with that is a loss of knowledge and business expertise. And yet we're going to want to redefine these processes around knowledge about the business of insurance, and needing to also add in this aspect of AI. So it kind of gets into this structure of, human-centric AI, but how do we kind of begin to deal with that? Because to really get the value of AI, we need also the knowledge of inside the organizations that is, in many cases, a rare commodity these days. Rob?
Yeah, so as a friend of mine once said, other than that, Mrs. Lincoln, how was the play? I think that these are really fundamental issues that carriers need to get after. And I want to go back and touch on something Jim said, because one of the more fascinating bits that I think I've had the chance to read recently have been some reports and studies that Morningstar has produced. And of course, the venture capital and private equity communities have invested significantly in AI and have certainly built up a following around all of the future state promise that comes from the technology. But the fundamental point in the articles has been now some of these entities are starting to actually eat their own cooking, use the tools that they've invested in to try and drive value. And some of the more fascinating comments that come from that are, the real problem we're having is that we're not getting much value from this because we've got bad data. And of course, if they've got bad data in the private equity world, that very much speaks to some of the challenges in the insurance world, which then gets back to, it's not about having a lot of data, it's about having good data. And so some of those things that need to be done in order to be able to generate value in the future state actually require companies to start thinking about some fairly fundamental blocking and tackling, like cleaning up the data or finding data repositories that can actually drive some of the value. And then you get to the human component. And you're right, that many organizations have actually fostered losing some of the expertise on the business operations side so that they could become more efficient, back to this whole conversation around business process improvements and other things where people have been trying to optimize for a quarter of a century or more to improve marginally some of the operations that they have. And now you wind up in this state where it turns out for many companies, they're down to onesies and twosies of people who actually understand what happens. And from our experience, they may understand what happens. They don't know why it happens, which makes them uniquely unqualified to be producing some of the requirements to create future state business process. So I think carriers should probably take some nod from one of John Kennedy's State of the Union addresses, where he said, the best time to fix your roof is when the sun is shining. So we're not there yet in terms of all of these demographic shifts that will hit, but we're heading there fast. Now is a real opportunity to start to think about how some of the human capital will be realigned and prepared for what comes next. Denise, you and I have talked about the U.S. labor force is going to be comprised 70% of millennials, Zoomers, and alphas. So we have this fairly narrow window where younger boomers and older Gen Xers are still here, but will be retiring in fairly large numbers, capturing the knowledge, using it as the basis for creating a better understanding of some of the things that we do, some of the things that we should not do, would be money well spent getting ready to prepare for how these new technologies can be used. Failing to do some of that fundamental work around data and around human capital actually will lead to ready, fire, aim events, which are really unfortunate. Very expensive, don't produce much value, but are spectacularly interesting to watch as they head towards failure. I think that, that's one of the more difficult things when you've got a technology that's emergent like AI, where people love to talk it in breathless accolades. And to be clear, it's really important technology, but don't understand some of the foundational pieces that are required to make it work. And then you get to the cultural component, right, where making big changes are difficult because now you really are impacting people, executives, their view of the world, the spans of control, the size of their operations. And it's always best if we do that to somebody else rather than doing it to me. One of the things that we noticed with some of our carrier clients that we've been working with in the past year is that where they've got the greatest value of deploying some of the AI tooling has actually been in the investments and finance functions. Back to where are you really going to extract value? But they did it by commingling IT resources or technical resources with business resources and avoiding the temptation to make this a technology solution where the equivalent of, hi, I'm from the IRS and I'm here to help is the message. Instead, it becomes a message of here is some of the tooling, here are some of the capabilities. Business executives should drive it so that they can improve their own operations. And that can also be a pretty fundamental shift in how people think about the interoperability between technology and business areas. So really interesting items that I think we're going to have to deal with, and they're simultaneous equations. They can't be dealt with sequentially. They've got to be dealt with concurrently.
Yeah, and I think when I kind of tie, the first two topics together, and there's a lot of reports by all of the BCG, Forbes, McKinsey, AM Best. There's a lot of them out there. I think the really interesting thing is that if we're not really re-looking at this operating model in a technology foundation and making it relevant to today and into the future, to really drive to, Lisa, your point about the economics, the difference in economics, we've got to really kind of change that. There's estimates that, AI fundamentally within operations could have an impact of 3 to 5% reduction in expenses. And when you accumulate that out, it could have a pretty substantial impact from an insurance perspective of double digits. And that then will have a fundamental change in how you can price the products and how you're competitive in the marketplace. And in my conversation with the CEO yesterday, we both agreed that that leads to potential 3 to 5 years down the road. You could begin to see a restructure of who the leaders in the marketplace are from a product competitive standpoint. So Lisa or Jim, do you guys want to comment anything last before I move on to the next section?
Lisa, you want to take that one?
Yeah, I mean, the only thing I was going to say, just as a plus, is just, I think that it's interesting to look at training AI models and feedback loops. And I think that we think of people and knowledge and institutional knowledge as binary, meaning it's either from the person or it's like in the machine. And the greatest use and extraction of institutional knowledge, in my opinion, has been things like code review, when the senior engineers are looking at, AI-based coding. We're seeing similar things in control process review. We're seeing similar things in LLM, and like all these different policy forms and accord form completion, Denise, and how a senior broker can look at things differently, and that feedback loop that's naturally occurring, I think, is actually probably one of the best ways. I think of it as like the Vulcan mind meld. One of the best ways to extract what's in people's brains, because I don't know about you all, but for the last decades, every time I've gone to any really experienced person and I said, tell me what you do, there's only so much mental capacity to explain everything. And that's why, past process improvement projects failed, systems project failed, stabilization's always high. And so I think in this new world, if I were leveraging one thing, it would be to get the most senior people involved in the highest technology, sophisticated AI training integration projects, so that I could get, in essence, a DNA imprint of that knowledge in my system. That, to me, is something I think most people are overlooking. Sorry, Denise, I just wanted to add in on that.
That's okay. All right, on to the next topic, InsurTech zombies, a new phase of InsurTech. So, the emergence of InsurTech in the, 2014 era, we're 10 plus years into InsurTech, and we've seen it evolve over that period of time. But the pace of change and the economic dynamics, like we talked about previously, has really, I think, accelerated some of that change as it was, 3-5 years ago. It's no longer, lots of money flowing in and growth at any cost. There has to be some element of profitability. There has to be some element of some really strong business metrics. Rob, your perspective is, do you think the model is broken, and would it require, a better economic awareness and the value that they do?
I think that the world is changing around some of this, to be clear. I think that, the InsurTech and FinTech emergence more than a decade ago was a very exciting time in terms of the ability to try and move quickly, break things, learn new things, bring capabilities to market. And I think both the companies that were part of that community as well as the buyers learned a lot from that. I think we live in a world today where interest rates are different, where economic headwinds are different, right? You step back and we're in a recession, we're not in a recession. HB1 visas are going to adversely impact us. They're not in terms of their availability. Tariffs are going to impact us adversely. No, they're not. So a lot of uncertainty as you look at this. And then you add into that one of the things that I think we've all learned, which is that when you look at venture capital or private equity investments in startups, there is an effort to get them up and running and moving forward, but there's always an exit at the end of that, where it's going to wind up being something in somebody else's portfolio. And I think that one of the cautionary tales right now is, I want to understand technology roadmaps, certainly, but probably want to, as a carrier or as a potential buyer of things, I want to understand the ownership roadmap. because as we look at the complexity of some of the things that have been built out, and the number of participants in any particular carrier ecosystem that may exist, can be real significant challenges that come from a surprise transfer of ownership or a surprise failure of an entity, a surprise when potentially one of your competitors buys something else that you thought of as being really important in what you were doing. So I think we're at the precipice of some real and significant change in terms of how the startup world works and what carriers will be looking at. I think we won't get away from this notion that it is an important part of how innovation unfolds, but I think it's going to be different going forward. You know, in the pharmaceutical industry, M&A was frequent, or R&D actually was frequently spelled M&A, that it was the big companies that bought up the small ones to try and create more capabilities, more products in their inventory. And it may well be that we see more and more of that in what we think of as the insurance technology realm as well, because there is a stability that's implied by some of the nature of companies that carriers may want to deal with. And thinking differently about how they want to manage some of those risks into the future, I think is also going to be part of how some of that investment strategy plays out. So I do think it's going to be different going forward, Denise. I think it's going to be fascinating to watch, but I think it's going to fundamentally put pressure on insurance companies to do potentially even more than they've done historically around understanding how contracts are developed, and in particular, what happens with change in control language when they're built into those contracts.
So, Jim, kind of building on that, I'll add another layer of a question on top of this to get your view of, you know, this new phase of InsurTech. You know, I talked about InsurTech zombies in my trends report, and you know, it really comes from you know, the VC and the private equity firms that the companies that they invested in or that they bought didn't necessarily have the level of profitability to be able to then once again invest back into the business. But we have that problem with some existing InsurTechs that are more established. It could be small companies, it could be large companies, and their inability to invest in the business and in particular in the technology given the pace of change. So what kind of operational and strategic risk do you think these types of technology companies that insurers are looking to partner with, or they actually have them running their business, I think it creates a level of risk that is pretty dramatic. And you work with a large number of both tech and insurers. What's your view on that?
Yeah, I think first, really nice article, by the way. Not to show for stuff Denise writes, but yeah, read it. First thought, in the investment markets, capital always tends to chase success. Oh, somebody did this, I'm sure I can replicate that. Let me go find somebody to go do. One of the challenges, I think, is that the way the technology itself has evolved is that the barrier to entry for InsurTech or for any sort of fintech, for that matter, has declined dramatically. We now have the ability to say, because we have some of this technology around agents, because we've created interoperability with MCP, basically we've made service-oriented architecture actually a real thing, which means I can plug in something small and have it go big. Those capabilities have changed somewhat the economic model that's fitting in, and it's a disadvantage in many respects to folks that we would have called the earlier InsurTechs, largely because they built before this infrastructure was available. A good example of this, in the re-business, we've been looking at sort of the placement of reinsurance, and there's some folks who have spent hundreds of millions of dollars building fantastic placement models in the re-business. And you're seeing now, within the last 6 months, companies spending less than $4 or $5 million replicating that exact same capability with much smaller teams in a much more agile way, because we're able to leverage this interoperability model that just didn't exist even 2-3 years ago. So I think the challenge we're going to face is, in many respects, the same sunk cost challenge we had before. The large monolithic spend, which was a lot smaller and a lot less monolithic when we started to see the emergence of InsurTech, we're now seeing people able to plug in, provide very crisp value, with very small agents that do X, that fit into a process or reinvent a process. And I think that's going to exacerbate it. It'd be interesting to see whether or not the insurers themselves or the brokers or somewhere along the value chain, you're going to see people aggregating those small pieces to create more of a framework approach. If that happens, then sort of the way capital markets approach InsurTechs will fundamentally have to change.
So Lisa, put your CFO hat back on. How does this change and how insurers should kind of reevaluate how they go about the selection process? It's not about how pretty the screens are or the feature functions. It might be really some more fundamental issues that have to come into play.
Hence why I never look at a demo when I buy tech. To all my tech people who want a demo, you'll never get a purchase order from me that way. No, but quite candidly, I love all the things that have been said, and I guess like my lens on this, Denise, and I'm very much coming from a CFO procurement perspective, is if you think about what engine has been rewarding the InsurTechs, it is predominantly VC backed, right? And in a VC backed model, these tech companies had been told to go full stack. And I'll just pick on geospatial solutions, Denise, just as an example. So meaning they've got A to B, like all the way up to the UI, all the things, and I'll use geocoding for the concept of this discussion. They've got geocoding in it, whatever. And let's just say that as a carrier, I need 10 bits and bots of these incremental solutions, the point Jim was making, to get to a solution. And unfortunately, not a lot of people have been putting that together for me, Jim. So I've got to still be the Lego master here and assemble the little bricks and blocks, which I'm happy to do. The problem is, in my example, every single one of these 10 solutions has geocoding in it. Every single one of them has, some form of I'll call it data denormalization and then blah, blah, blah in it. And so what happens from the CFO perspective, Denise, is I'm carrying basically duplicative load. I've been talking to chief procurement officers about this for 2 or 3 years before the zombie report came out. And I kept thinking, you've got to strip that out. Denise, I would strip out the UI layer because most of this going in is a pipe, not a user interface, because how many UIs can we have people in when we're running a carrier? And so I've got to strip up the top, and I've got to basically strip out all the redundancy in the middle and bottom layers. Well, that is counterintuitive to what these InsurTechs have, A, the agility to do, and B, the VC backing to do. Because they, hypothetically think they're going to sell this little widget for, excess of hundreds of thousands of dollars to, thousands and thousands of carriers to make their, $100 million, billion-dollar valuation. And so when you put the economics together and you start to think of the redundancy, and then you start to go back to the economics, the unit economics that make insurance work, it doesn't add up. And it doesn't take a rocket scientist to figure that out, Denise. So in my mind, to make this work, you have to go almost like a wholesale model. How do I get in the middle of the widget that I need? And how do I buy the part, not the whole? I think that is going to be incredibly important and imperative. And to date, I have not found a lot of off-the-shelf products that allow a carrier to do that. So I guess the only thing I would say, Denise, that's missing is you're going to either need, I'll leverage this since Majesco. You're either going to need a Majesco to integrate something like that and kind of pull all that out for you, or you're going to have to go do a heck of a lot of work synthesizing and doing what I just articulated.
So great insights, Lisa. Before I go to the next section, we have a question. Rob, I'll maybe let you kind of address this because you were talking about it. How are you dealing with capability gap, upscaling teams, and enabling them to work confidently with these tools?
Well, I think that carriers need to start to understand what it is that they're going to be contributing into this mix around the skill sets. I think in some cases you can find the answers in the Wayback Machine. Long ago and far away at some point in the last century, I started working at Prudential when I was a rising junior in college, and my career trajectory was that they continued to invest and make opportunities available to me and reskill me on different things. Yes, I did eventually leave, but I stayed for a really long time. And I think that carriers now need to think about, are they in this for a long game or a short game? So thinking about how they're going to help with the reskilling is part of it. I think that one of the things that I did when I was a CIO here in North Carolina for several companies is I developed very close working relationships with some of the universities in our community, North Carolina State University being one. And I found that they had really great programs that I could become a part of. So I was contributing back to them. It gave me try before you buy opportunities, early insights into people, and creating different kinds of career trajectories. I think that's part of what people need to be very mindful of. I think that in many instances, carriers aren't necessarily aware of what's going on in their own communities, or they're not aware of how other companies may be operating there. So in Southern Ohio, one example, I know a number of companies there found that they were missing out on some of the very best talent that they could have gotten from local schools. And part of it was because Procter & Gamble was hiring people long before they ever came on the radar of insurance companies, either in the IT world or otherwise. So I think part of it is how you think about different onboarding models. I think you need to rethink some of the career models. I think you may need to rethink some of your partnership models. That things that made sense when it was all about labor arbitrage at one point may make less sense now. And it may be that you need different kinds of partners to bring some of those skills to bear. I would say one of the fundamental issues that we see in the companies that we talk to is a remarkable lack of business knowledge in the emergent IT community. And that creates really interesting challenges if the IT organizations are actually going to be able to help solve some of these hardcore fundamental business problems. They may be wonderful technologists, but if they don't know what IBNR is on the PNC side, or if they don't know what a 1035 exchange is on the annuity side, it may make it really difficult for some of those people to actually be part of those conversations where you're trying to drive to better solutions. So I think it is, again, potentially rethinking how some of these labor models work and looking at things that have worked in the past to see if there's a new variation on that that can be helpful in the future. And again, I would strongly encourage looking locally, because there are some remarkable things in various communities where schools are there and they're looking for opportunities to partner with financial services companies. But it takes two to tango. You got to be open to the idea in order for it to work.
Yep. All right, on to the last section before I get to the bold predictions. As an industry, we've over the last as long as I've been in this industry, Lisa, I'm like you. I'm not going to say how long I've been in it, but we've argued about what is the business of insurance. And I think, trying to tie everything together that we've talked about, the operating model, the technology foundation, different sets of risk, what are the right metrics, all of those things kind of come into come together to say, what is truly the business of insurance today? Is it asset management? Is it about the products? Is it about the customer? Is it about the agents or the distributors? Is it about risk management? Is it distribution focused? Which of those are going to really define the growth? And ultimately, quite frankly, because the purpose of insurance is really to provide that protection, whether it's to businesses or individuals, it's getting too pricey that people are down selecting insurance. How do we kind of close that protection gap? So, Lisa, I'm going to start with you first. Jim, I'm going to go to you real quickly, and then Rob, and then I'm going to go to the bold prediction. So, Lisa, to you.
Okay, I'll be quick on this. I mean, I really think if we step out of the, the tactical things that we do in insurance, which of course we get into a lot, I really think it's really no longer about policies, premiums, or risk transfer. I believe it is decision execution under uncertainty at scale. So meaning, I think we no longer sell products, we operate judgment. And I'll just leave it at that, Denise.
Love that. Jim?
I want to listen to that one again and just re-record and push playback on that. That's awesome, Lisa. I'd say if you want to see where the direction of the business insurance, it's always good to watch what the brokers are doing. Because the brokers are shifting focus in a number of different ways that's worth sort of identifying. We're seeing more and more emphasis put on risk planning and risk prevention. Stuff that, we tried in the 90s, we lost our shirts on it as insurers. We're seeing this idea of risk mitigation. We're seeing it in everything from cyber to catastrophe risk. And from there, if we start looking at this sort of prudent use of risk planning, that shift in the business will actually fundamentally change how insurers look at the value prop as well. And I think there's going to be a lot more to come in that, and not just in the property casualty space, absolutely in the life, health, wealth space. We're seeing all of this the new construct of what longevity means. Those would be places where also we're going to see an interaction between planning and planning tools, a lot of that coming from AI, together with good, strong advisory services to really rethink about the prevention and the mitigation of risk and prudent judgment. I'll misquote you there, Lisa, but it's, I think, a great way of looking at it to then hit the mark.
And Rob, what's your view?
Oh, I think that it would be incumbent on insurance carriers and brokers, I think across the industry, to think about just exactly what does the future look like and what are people trying to be protected from or for. I think that life here in the 2020s is very different than the life some of us experienced in the 1990s or 80s. I think that in the future, when I think about how family formations take place, how people will transit themselves, how people will invest money, thinking that the past is a good predictor of the future is probably not a great idea. And so understanding more fundamentally how some of these demographic shifts and changes will play out, I think will help, as the quote about Wayne Gretzky once was, skate to where the puck is going to be, not where it is right now. Understanding where it's going to be, I think, is pretty important. I think, not to focus too much on demographics, but it's a really important thing inside insurance companies, but it's also a really important thing in the distribution world. The average age of an insurance agent today is something on the order of 62. I'm here to tell you that's not old. But when you think about that as an average, that's kind of stunning. And then when you think about the fact that human beings tend to buy things from other human beings that are plus or minus 10 years of their own age, it may well help to explain why in some parts of the insurance world, the average customer base has been aging rather dramatically, and where carriers have fundamentally struggled to try and broach younger clients. And part of it is they don't really have a means for reaching into that. So I think that there are some really interesting issues ahead of us. And then, of course, you would layer onto all of that at some point over the course of the next, couple of decades, I hope, we're going to watch a really significant intergenerational wealth transfer take place. And if insurance companies want to be a part of that, they better get their act together in terms of understanding how those changes are impacting consumers now and in the not terribly distant future.
Great. So I'm going to go to each of you kind of share your one bold prediction for 2026 and why that is. So Lisa, I'm going to start with you.
All right. Thank you, Denise. I had to work on this one. My 2026 prediction is insurance won't be disrupted by new risk. It will be disrupted by how systems decide. The biggest failures won't come from underwriting. They'll come from opaque automation and AI acting faster than governance can keep up. The carriers that win won't be the ones with the most pilots, Denise. They'll be the ones who redesign their operating models, as we've been discussing, so that risk is actually embedded in the execution layers, decisions are reversible, and humans stay in the loop when outcomes are irreversible. By the end of 2026, the question won't be, can AI help us? It will be, do we actually control how our systems act?
Oh, love that.
That's my prediction.
All righty. Jim, over to you.
You made me follow that. Lisa, brilliant stuff.
I just volleyed it up for you, Jim.
Look at you. Perhaps the way I look at it is this: we have a lot of carriers ask, how can I leverage technology to reduce my cost? And the old adage still applies, and at least I want to pull in like three different things he said, but I'll just come to this point: you cannot shrink to grow. And what we're seeing traditionally is this idea of the carriers who are using, or the insurance providers and members of the value stream who are saying, I want to leverage AI just to lower my cost, are going to miss the mark, and they're going to start seeing their share erode, and not just their share relative to competitors, but their share across that sort of value chain or value web. Demographics absolutely matter in this. Folks who are cutting off their young in order to serve their old will find themselves spending way more money 5 years from now than they did to get talent into the house. And they're going to find themselves lacking that understanding and the institutional knowledge as folks who are leaving their organization leave with no one to pick it up. So from that perspective, the prediction for 2026 is the people who are actually coming to me and saying, how do I eliminate jobs with AI, or how do I just make myself more operationally efficient, will be coming to others in 2027 asking, how do I grow my business again?
I love it. Rob.
So I completely agree that this notion of how you grow your business is absolutely key. So I think Jim nailed it. I also want to be clear that I am not a technology Luddite, that I think that AI is a very important technology, just as I thought the internet was before that, and the browser, and the personal computer. I think that one of the realities that's going to dawn in 2026 is that those who rush into AI without a really good understanding of governance and some of the foundational elements that are required to make it work are going to find themselves in a very unfortunate place relative to some of the cleanup efforts that they're going to have to make. And I lived through the last citizen computing revolution when things like Microsoft Office and Access databases became something that were widespread. And there are wonderful tools, absolutely. But the damage that was done in some of the companies that I worked in because of a failure to govern things and to not fully appreciate that you actually do need to test things that you're going to put in production, or that you need to have some sort of backup plan for some of these things that gets deployed. Well, if you didn't enjoy all those conversations with your internal and external auditors back then, just wait, because I think some of the technical debt that's already being accumulated from AI efforts run rogue are likely to be really problematic for companies. So I like to focus a little bit on the Bill Gates quote from his book in 1995 that said that we always tend to overestimate the impact of technology in the short term and underestimate it in the long. And I think that this is a time when thinking about the incredible value that can be created from some of the new and emergent technologies is an appropriate thing to do. But that setting the foundation, setting the governance, structuring things in such a way that you're really able to get that value is going to be important. And I don't think enough time has been spent talking about how companies will do that. So again, I think it's great technology. I think there's going to be some disappointment as we get towards the end of the year and people realize they didn't do the basic blocking and tackling up front.
Wow. Okay. So this has been a fantastic conversation. It was really great. I think we've got some bold predictions. The bold prediction that I would put out to everybody is that I think by the end of 2026, we are going to see the start of a number of companies that may not really be the names that you would expect, but that are actually doing some of the things that we talked about here on this panel. Relooking at the operating model and defining what they are as an organization, and then starting to put that technology foundation in place to really drive growth. I think it's really the rethinking of the business and the industry as a whole, and I think we will begin to see by the end of 26 the lights of opportunity and the lights of hope out there that we haven't seen before. So once again, thank you for your participation, Rob, Lisa, and Jim. This has been fantastic. We will be building out a couple of blogs on this, and so you can determine if you would like to, have further conversation. Just reach out to all three of us. Thank you, everybody.
Thank you, Denise.
Thanks, Denise.